Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Thursday, May 2nd, 2024. Today we had initial jobless claims come out a little lower than expected, showing that jobs may be stronger than expected. Again, I don't like initial jobless claims. It seems to be disconnected a little bit from the actual unemployment rates. A lot of higher paying tech jobs are gone, and people have been taking multiple jobs, and I think that's partially as to what is going on here. As far as by itself, initial jobless claims being lower than expected, and then factory orders also slightly lower than expected. Now, Friday is the big numbers. The one I'm really looking for is the U.S. unemployment rate. I recently heard Ira Epstein, a very good chart reader that I follow on YouTube as well. He had said that, things will start to really crack. His number is looking for 4.2%. And I agree. When I look back at the history of the unemployment rate, you look at the angle of the curve that it's going up. If we were to see a number like that, we could really see, well, what will happen is we'll have lower rates for a little bit. Stocks will go up, and then, until people realize that, cuts are not actually a good thing. It means the economy is actually crashing. And that's when you get your yield curve uninversion and the recession. That's the typical story, how this usually plays out. But we'll see how it goes. Gareth Soloway, Master Seance, on his show had mentioned some of the movement in markets today looked to him like maybe these numbers had gotten leaked, or no, he said the tone of Powell talking yesterday seemed like he was less hawkish, making people think that the unemployment rate is probably higher than what we're expecting. So we'll see how that plays out. I have been saying that I think that it's been trending up, and so I think it's very reasonable to expect the unemployment rate to be going higher here. The S&P 500 today was up 1%, but when I look at a chart zooming out just a little bit, it's definitely nothing to get excited about. It still looks to me like we are bearish here. Same thing in the NASDAQ and the Qs. If I just do a rough line here, it's like, where are we headed? Well, to my eye, it looks like we're bouncing down. But who knows? It's not like I'm the guy with the crystal ball. HYT, I've been saying I was surprised it keeps breaking into this first candle of the three black crows. Again, HYT being bonds, a collection of bonds that have higher risk of default that are issued from companies that have to pay higher on their debt because they are more risky companies. And this is my favorite leading indicator. That's where the smartest money is really saying what the risk here is in high yield corporate securities. And today we opened higher into this first candle. I'll be interested to see if we break even above this candle. And I am still expecting this, though, to roll over here. I found it extremely interesting that the Fear and Greed Index on CNN yesterday was 40 and today was 36. So in other words, more fear going on. By the way, the VIX is down too, all while the stock markets are going up. I found that to be very interesting. It has to do with their methodology. If I scroll down here, sorry if it's making you dizzy, but part of it is how many stocks are doing well and also safe haven demand. And we saw a bid in bonds today, longer bonds anyway. we have some interesting things going on in the further out in the yield curve that I'll bring up now. First of all, TLT, this is a treasury bond fund, longer duration, which means when long interest rates go down, the value of these bonds goes up pretty dramatically because of the length of the bond, the length of the life of the bond. And we had this candle here is pretty engulfing. It engulfed May 1st, it engulfed April 30th. We didn't quite engulf the 29th, but you can see that it covered a good amount of these previous candles. This is a very bullish sign to me in long bonds. The odd thing that I noticed was, again, this chart ends at 1:59 p.m. apparently, but I found it very interesting that the 10-year note yield was actually negative 0.52 today, while the 30-year bond yield officially was actually up 0.1% today. So that divergence, I really don't know what's going on here. I have a feeling it's nothing to be too concerned over, but strange and interesting nonetheless. The last chart I wanted to bring up today was KWEB. I've been talking about KWEB and how happy I've been having 10% of my portfolio basically in this fund in China. And wow, it went up 8%, almost 8% today. This is an index of companies like Amazon and JD. JD or Alibaba are the versions of our Amazon. Internet companies of China just skyrocketing today. So, my question is this another one of these blow-off tops like we've seen many times before where we run up and the market sells right back off? Or is this looking more bullish? To my eye, it is looking pretty strong here. Again, my target actually on KWEB, if we zoom out to the max position, I'm not looking for 2021 highs. I'm looking for a more reasonable range between 40 and 50. We've seen a battle there before many times. It's peaked there all the way back in 2015. It's not unreasonable to see a fund get back up to a more reasonable valuation. So why are Chinese equities suddenly popping massively today? One important thing that Benjamin Graham says in security analysis is to actually not care too much about diving too deep into things. I briefly scanned the news with China, and at the end of the day, even the craziest headline you've ever seen doesn't matter. When it comes to how the world operates, as much as we're fearful of how China operates in their politics and their control of businesses, businesses run the world. They have good businesses that make good money. They exist. And unless they want their country to fail, they depend on these companies. The world depends on companies doing well. It's just the way the world works. And so it's, to my understanding and knowledge, the details of what's going on are not always very important. You don't always have to dig so deep. Sometimes a smaller amount of information is enough. And simply taking a look at this fund here is enough for me. When I see that the valuation of this fund, KWEB, was cheap compared to its future all the way back in 2013, 2014, at above the current, at about that price now, $30 a share. It was cheap then. all the way back 10 years ago, and we're supposed to believe that this is not cheap now. This is an exciting opportunity, and I'm not looking to get rich here, although I will profit handsomely by taking the risk here. All I'm looking for is a little bit of normalization. If we get into the $40 to $50 range, I got fat and I didn't get slaughtered, because pigs get fat and hogs get slaughtered. That's all I have for you today. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.